After watching The Big Short, have you ever thought about how to make a Big Short trade of your own? I know I have, but unfortunately, normal people like us can't place trades like the ones they did in the movie because, as the movie points out, you would need an ISDA. And again, as the movie points out, to get an ISDA, you would need more than $1 billion. But there is still some hope for us normal people, as these two guys made millions of dollars from 110K in just several years before they made their famous bet against the US housing market. And they started out in a regular old trading account just like the rest of us. In this video, we'll get a glimpse into their trading strategy by taking a dive into 3 of their earlier trades that helped them get to their initial $30 million in profits from just 110K. And hopefully, by studying their trades, we can achieve some of the alpha they have. Now, let's get into it. Trade number 1, Capital One. On July 18th, 2002, Capital One stock fell about 40% from roughly $50 to about $30, and it continued to fall another 20% into the next trading day for a total decline of about 60%. This dramatic decrease was due to a voluntary news release that Capital One was in disagreement with regulators about the need to increase reserves to improve their credit risk against subprime loans. Up until this point, Capital One was thought to have superior profits due to their advanced models for assessing subprime risks. So after this news broke, the idea was that Capital One either truly had better models for assessing subprime lending, or there was fraudulent accounting hiding losses. Also, it didn't help matters when the SEC announced that they were going to investigate the company's prior CFO for insider trading due to a stock sale a couple months before the announcement that caused the stock to drop. This situation created what's called a bimodal event that Jaime and Charlie believed the options market was mispricing, meaning the company was either A, fraudulent and worth zero, or B, an honest company that just had a disagreement with regulators over reserves and was worth about $60. The two did their due diligence by speaking with people the CEO went to school with, reached out to the chief risk officer, mainly because they knew they wouldn't have been able to meet with the CEO due to their small fund size, and pored over the company's financials, all to determine that the management team at Capital One were not crooks and the company was not fraudulent, which means the decline in the stock price was overdone. So to play their thesis, they spent roughly $26,000 for 80 leap call options with a strike price of $40 in Capital One. Within a year, their thesis that Capital One was an honest company turned out to be correct, and they closed their position for roughly $225,000. Trade number 2, Altria. In 2003, Altria was down almost 50% due to several large class action lawsuits, where each case had the potential to have settlements in the hundreds of millions, if not billions of dollars. This situation created another bimodal event, as the bears thought the company was going to enter bankruptcy as a result of all the lawsuits, and the bulls thought these lawsuits had no merit because under the Tobacco Master Settlement Agreement of the late 90s and several other separate state settlements, the tobacco companies already had reached an agreement with all 50 states. And to top it off, the American people already had a controlling interest in the tobacco companies, as more than half of tobacco sales are taxed to various federal, state, and local governments. The Cornwall Capital team reached out to many litigators who were not involved in the case but were closely following them to assess the probable outcomes of the lawsuits. After 2 months of playing out various scenarios, they felt the price decline was overdone and the risk was to the upside. And to execute their conclusion, they once again saw that the options market mispriced the event, and they bought calls which multiplied their investment by 2.5x after one of the lawsuits was thrown out on appeal. Trade number 3, South Korean stocks. In 2005, the Cornwall Capital team invested in Korea. The market came to their attention because Korean stocks looked cheap based on their fundamentals. For example, there were companies that had market caps of $300 million, no debt, with $500 million in cash and positive cash flow. And with the positive cash flow, their cash reserves were projected to grow to $650 million within the next year. They were not sure why the market was so mispriced, especially since South Korea had outperformed other Asian countries in applying financial regulations and complying to the IMF emergency loan terms after the 1997 Asian financial crisis. To figure out the reasoning behind the mispriced market, Cornwall hired an undergrad from Berkeley to translate financial statements to English, developed a relationship with a family member of one of Korea's largest family controlled companies, met with lots of industry experts, and even traveled to Korea many times. All their due diligence pointed to a simple answer: South Korean stocks were cheap because they were always cheap, and many investors got burned by getting into the South Korean market too early, thinking it was cheap too. But the companies kept getting cheaper due to their positive cash flow, and it couldn't be ignored. It is not mentioned how much they made on this investment, but considering they were buying companies for less than the cash held on the books and the companies had positive cash flow, it's safe to say their investments turned out well. Application. Simply put, the Cornwall strategy revolves around finding mispriced assets and doing an extensive amount of research to best capitalize on the mispricing. And although the trades mentioned in this video are about 20 years old, I believe the logic behind the trades are still applicable today. And it's worth trying to re-engineer the trades of successful traders to gain a deeper understanding of them to apply to our own investment and trading styles.